Bitcoin formed a very big bottom in, late 2018, early 2019, and then it grinded significantly higher. But then it kind of retested that bottom very briefly during the March 2020 sell-off. I think we start with 100,000 or 120,000 and see if we get to that before making higher conviction, higher price targets from there.
Bitcoin held its most recent gains into May 27th as traders called for a change in bearish market sentiment. Hello, and welcome to Crypto Street. In this video, we have the privilege of exploring the interesting perspectives of none other than Lyn Alden. Get ready to uncover the secrets of the future of Bitcoin, so let's get started.
Bitcoin formed a very big bottom in, late 2018, early 2019, and then it grinded significantly higher. But then it kind of retested that bottom very briefly during the March 2020 sell-off. And so it didn't hit like lower lows, but it did kind of briefly go back and plumb those depths. And the difference was that it didn't stay there for many months. It just kind of had this like big flick down, and you had the liquidity response, and a number of weeks later, it was already back up to well above that bottom. And I think you could see a similar thing where you get kind of a brief problem that brings it down maybe lower than we expect. But I don't think it would stay in that lower band. I wouldn't be surprised to see it touch the lower 20s again if we get that specific scenario of a liquidity crisis from trying to refill the Treasury General account. There are scenarios that I think could push it to the upper teens yet again. But I think that would be it probably spend less time there than it did in this prior bottom. And instead, if they actually front run this, if the Fed ends quantitative tightening before you get the Treasury pull up, or if the Treasury does proactively kind of focus on issuing T-bills or increasing their Treasury account slower, then I think you're much less likely to retest those lows. Yeah, I think the next 2 years or 3 years look very constructive. I think basically we have this window where the next 6 months, there's a lot of variables that I think could throw us off. I think Stanley Druckenmiller said it best. He's like, I can make the case for deflation, or I can make the case for 8% inflation. Mm-hmm. And I think he's touching on the same kind of uncertainties I'm touching on here, which is that there's very key decision points that a handful of individuals can make, and that can determine pretty big swings in what happens. So I think that basically next 6 months for Bitcoin, very unclear. I can make the case for retesting the lows, or I can make the case for, not going below 25,000. But that I think that the 2-year or the 3-year case is very, very strong. I have high conviction that basically we'll probably have another positive liquidity cycle in that environment. And right now the valuation is very attractive, compared to its longer term, say, moving averages. I also think if you look at Bitcoin holding behavior, generally one thing you see in bull markets is that long-term holders begin selling some of their Bitcoin because they're up 5x, 10x, all this new money's rushing in, and they're reducing their positions. When you have bear markets, you generally instead see long-term holders are not selling, that they're buying more. And you start to get a very large percentage of Bitcoin that haven't moved in a year or more. And right now, we're very tight in that metric. Basically, we have a lot of indicators kind of either pointing that the bottom's in, or that the bottom at most is likely to be retested. And so I'm very constructive with, say, a 2 to 3 year view.
Data from Cointelegraph Markets Pro and TradingView followed BTC USD as it entered the weekend at around $26,700. The week's macroeconomic data from the United States had ended with a surprise, as a new personal consumption expenditures (PCE) index print showed the economy weathering tighter financial conditions much better than expected. Markets then began to price in a June interest rate hike from the Federal Reserve, which should form a headwind for risk assets, but failed to dampen a BTC price rebound.
I think longer term, it wouldn't change the thesis of Bitcoin, 10 years from now, being much higher than it is. But I think that could add a number of years towards the next new all-time high, or, the number of years it takes to get to, say, a 6-figure price target. As far as derailing the thesis permanently, I think you'd need something absolutely critical, like a completely catastrophic bug or some other problem with the consensus itself. That would be, I think, the kind of the main thesis, like damaging thing from there. And even at that point, there are ways that the network can adjust. You can do basically various forks to fix the problem, but it would damage the reputation of the network if you would have something pretty catastrophic like that happen. So I think in the near term, de-dollarization is probably overstated. Mm-hmm. It's easier to say something like, it's easier for BRICS nations to say we're going to do something than to actually agree on it, build it, make it credible, and start using it at significant volumes. So we've seen kind of a period of de-dollarization. I think the long-term trend towards de-dollarization is clear. Basically, this kind of period is somewhat unnatural to begin with. If we have a country with 5% of the world population, but we're responsible for like 90% of international currency swaps, that's kind of a long-term unsustainable situation anyway. We've seen, for example, as India and China and the BRICS nations in general become a larger percentage of global GDP than the G7 eventually, that does result in an inherently more multipolar world, and that necessitates a multipolar currency world and a multipolar payments world, so that one country can't just shut off payment systems of a country that's actually in some ways larger than itself. That wouldn't make sense. In the near term, I think some of these moves are, while they're happening, I think people might overstate the speed of them happening. So, for example, de-dollarization is not really a big theme for my, say, 1 to 2 year Bitcoin outlook, but I think it does factor into, say, a 5+ year Bitcoin outlook. I think that kind of like how when you have de-dollarization, there's more interest in central banks in gold as an asset.
Record buying, yeah.
Exactly. I think so. Right now, Bitcoin is generally too small for most sovereigns. You have some smaller ones like Kingdom of Bhutan that's mining Bitcoin. They're able to kind of get into that space, but generally it's not large enough to be a sovereign reserve asset. I think if you have another couple cycles of Bitcoin growth and you add to its market capitalization, to its liquidity, reduce its volatility, I think it could become a relevant sovereign reserve asset for some of these countries that want more independent, unsanctionable reserves that they can also use as unsanctionable payments. So I do think that Bitcoin is one of the solutions they can turn to, but right now it's, except for the smallest countries, is still in many ways too small for these bigger sovereigns to fully take it seriously.
Popular trader Skew noted Bitcoin's strong reaction at the 200-week moving average, MA, near $26,000, with more key trendline challenges now in the making. Price trying to reclaim 100 DMA after a nice move up from 200 WMA. Price is currently pinned between 4 HEMAs and 1 DMAs. Analysis of the 4-hour BTC USD chart stated the day prior.
I don't have a lot of insight in the probability of those outcomes, but what I am focused on is what happens after the debt ceiling. I think there's so much focus on the debt ceiling itself. There's not enough focus on what happens after the debt ceiling. And so for the past 6+ months, the story's been Fed quantitative tightening, raising rates, but something that's not been covered enough is that the Treasury has actually been offsetting a lot of the Fed's tightening. The Treasury has been emptying their cash account into the financial system. And partly that was because they had too much cash in their account to begin with compared to their target. But then starting in January, the debt ceiling actually made them lower their cash account. So when they were in a situation where they were no longer able to issue new debt, one of the ways that they deal with that is they say, okay, we have an existing cash balance that we can begin drawing down. And so their target is to have about $500 billion in that account at all times. In their preferred environment, that's what they would do. But in recent months and weeks, they've drawn that down to under 100 billion, which is way below their target because they still have bills to pay, but they're not able to issue debt. And ironically, while that's happening, while that cash is draining out of this Treasury void and back into the financial system, it's actually offsetting a lot of the QT that's been happening.
So they're nullifying each other. They're nulling each other.
Exactly. They're nullifying each other. But then the question becomes, when they actually solve the debt ceiling, if the Fed wants to keep doing quantitative tightening and the Treasury is no longer emptying its cash account because it'll be practically empty, and then if they want to refill their cash account back up to their target, then it's like a double negative for liquidity because they're actually joining the Fed in pulling liquidity out of the market. And I think that's where you could get breakage. If things surprise to the upside in terms of how bad they get, I think it would be because the Treasury does not manage that refilling process well. If they, for example, if they shorten the average duration of the treasuries that they want to issue, then they can probably handle it more smoothly because they can probably get money out of the reverse repo market and into their T-bills. If they try to refill the treasury account quickly, or they do it too much with longer duration bonds, they're more likely to cause yet another liquidity crisis because they risk pulling that liquidity out of the banks that are already very liquidity constrained.
Thank you for joining us on this thrilling exploration of the world of cryptocurrencies. We're eager to hear your thoughts on this thrilling topic. Don't miss out on all the action. Be sure to like this video and subscribe to our channel for more captivating content.